If you do one thing 10,000 times, it's always better than doing 10,000 different things only one time. Mastery comes from doing the same thing over and over again, learning from your mistakes and becoming a better version. If you master one trading strategy that works between 70 to 80% of the time, that's all you need to become a highly consistent profitable trader. So in this video, I'm going to be giving you that one trading strategy that you need to become a profitable trader. And if you put in enough effort learning this trading strategy, then you will definitely become a consistent profitable trader. Perhaps this trading strategy is one of the easiest that you are ever going to learn. But just before we start, if you are new to the channel, consider hitting the subscribe button and turn on the notification bell. And I have added all my social links in the description. Make sure after you watch this video, you follow me on my Instagram and Twitter as well. Now let's deep dive into today's video. So there are going to be few steps that you are going to need. First one is that we are always going to be focusing on the 15-minute time frame, as we are only targeting 20 pips from every single trade that we're going to be taking. So there is no reason for us doing the analysis on 1 hour time frame or 4 hour time frame or even lower than 15 minutes, which is 5 minutes or 3 minutes. I never recommend trading 5 minute or 3 minute time frame because they are very risky and highly volatile. So for this strategy, we are only going to be needing 15-minute time frame. The second step is that every single time when we will start the analysis, we're going to start the analysis by identifying the key support and resistance level. Now, what is a key support and resistance level? It's a level from where price keeps getting rejected again and again until market breaks that level and creates a higher high in case of buyers or creates a lower low in case of sellers. When market is making a higher high, that means it just broke the previous resistance level, and that should be a very important resistance level from where at least market rejected few times, and vice versa for the sell trend. The next step is that we are going to use two indicators. Both of them are going to be exponential moving average, and for the first exponential moving average we will be using 50 length. For the second exponential moving average we will be using 200 length. Fourth is we are never going to be buying high and selling low. We always need a premium price, we need a discount. That means we need a pullback from the market. Whenever market will create a higher high in case of an uptrend or will make a lower low in case of a downtrend, we will wait until market gives us a pullback. Not till when we need a pullback, from which level we should expect market to stop, that's we're going to look in a while. Now first thing first, we're going to open a 15-minute time frame on any pair that you want to trade. For this particular example, I have Euro Canadian dollar on the 15-minute time frame. The second step is we are going to identify the key support and resistance level. Now let's have a quick understanding of what is a key support or resistance level. Let's just say market is moving up and at a certain point market falls back down. It moves back to the downside. When it moves back to the downside, that is considered a resistance. Now if market is going to try again to go above that level and it is going to fail, that means this resistance is going to have quite a lot of significance. The reason is market is not simply able to break this resistance level, and if it will happen again, that is going to be considered our key resistance level because we have multiple rejections from this level. And market, when it will break, that means it's a break of a key resistance level and we have just created a higher high. That's for the key resistance. Now it's vice versa for the support level. Let's say market is falling down and at a certain level it gets a support, market goes up. When it goes up, if sellers are going to continue their movement to the downside, but they will not be able to break that support level and they will get a rejection and go up, that means this is our now key support level, as market is getting a lot of rejection here and it is having a hard time to go lower than that. Whenever we're going to break that level, that's going to consider a break of key support level and we will create a new lower low. That's the simple definition of key resistance and key support level. Now we have this current buyer strong movement to the upside, which we can see from here. Market is going to the upside. Now we just need to make sure whether we are breaking any previous key resistance or not. If we are breaking, that means yes, we are going to be adding our 2 exponential moving average and we are going to be then waiting for a pullback. To confirm whether we broke any key resistance or not, we just need to simply look at the left side, and on the left side we had this strong resistance level from here. When buyers went up, market got the resistance and it went down. Now after that, when buyers tried to go up again, it could not go up and sellers came back in. Now that becomes a key resistance level as we were getting a lot of rejections here. Hence, whenever market is gonna break this level, that's gonna be considered a break of key resistance. So when market made this strong movement, we broke this level, that is our break of resistance level. Now the next thing is we just need to add 2 exponential moving average. For that, go to the indicator section, type EMA. You're gonna choose this one, moving average exponential. Make sure to double click it. For the first EMA, we will change the input length from 9 to 50. For the second EMA, we will change the length from 9 to 200, and also we're going to change the color so that way we can at least differentiate which one is 200 MA and which one is 50 MA. That's how with the EMA market is going to look. This above one is our 50 EMA, the below one is our 200 EMA. Now yes, we know that we are in the uptrend, but it simply just does not mean that we're going to be randomly taking the buy position from such a higher price. We are always going to wait until market makes a pullback, gives us a premium price or a discount price. Now till when it's gonna come, from where we should be expecting a trade, let's talk about that now. Market is at the high level, it's gonna come down, it's gonna make a movement to the downside, sellers are gonna come until towards a certain level and then they will continue their movement to the upside. If the pullback will end and buyers will resume their trend. Now the reason that we have our 200 EMA and 50 EMA is that we're gonna wait until first point, market goes lower than our 50 EMA. The second point, we need to wait until market comes and touches 200 exponential moving average line. It has to go lower than 50 EMA and it has to come near to 200 EMA. So let's see how we're going to get a pullback. You can see market not even only went lower than 50 exponential moving average, but it is also now at 200 EMA. Now from this level, what we are going to do, we are going to wait until market will come back above on both of the EMAs, which means it should not only come higher than 200 EMA, but also at the same time, it should come higher than 50 EMA. Another key point, 50 exponential moving average, before we take the trade, it should always be higher than 200 exponential moving average. Now right here, when we have this market movement that just went higher than 200 EMA but also higher than 50 EMA, we're gonna place a trade. Anywhere you place the trade right after market went higher than 50 EMA and you put your stops just below the 200 EMA and you place your target for 20 pips, it's going to work very well. Now we have taken the trade, so let's see how it's gonna play out. Now here you can see that definitely when market it went higher than the 50 EMA, the reason why we placed the trade lower than 200 EMA, so that way there will be a minor chance that market will just take out our positions before it goes up. We put our stops lower than 200 EMA, market did come down but it got back from 200 EMA and exactly at 20 pips it hit our take profit. Now if you want to extend your take profit, let's say that you want to place your first take profit at 20 pips and you want to extend your take profit, then I recommend going for the recent higher high. And when you will move your take profit to the recent higher high, make sure that you move your stops to break even. So at this time your stops are at break even. You have taken some of the positions at 20 pips and your trade is running risk free. So let's see whether this trade is gonna hit our recent higher high or not. And here you go. It definitely even went higher than the recent higher high from where we placed our target. Then that was our 3.4 risk to reward ratio trade, which is more than enough because you will be just risking 1% to make more than 3.4% from every single trade. Now I'm gonna give you one more example so you can have a better understanding of how does this strategy work. Now on this 15-minute time frame on USD Japanese yen pair, we have this resistance level, which you can see from here. Market came to this level, sellers came down, market tried to break it but did not really go down, but it did fail in the second try before it broke it. So when it broke it, we know that yes, we have broken this key resistance level and we're simply just gonna wait until market comes not only lower than the 50 exponential moving average, but it should also be coming to the 200 EMA. Now one very important thing that we need to consider here, that if pullback is gonna be like this, it's gonna come way deep, then there is no point for us to take the trade because our trend is going from here to here, it's pulling back, then from this level it's going to the upside. So the lowest price from where buyers got a momentum to go up, create a new higher high, is that level. So we should only be expecting market to not go lower than this level in any case if we want to take the buy. So let's see how does the pullback is gonna come. Now pullback has definitely came down and it is lower than the 50 EMA and it is coming near to 200 EMA as well. And here you go. It touched the 200 EMA and it went up. However, we are still lower than our 50 EMA. And it is staying above 50 EMA, so we can simply just place our trade, put our stop loss just lower than the 200 EMA, and we can target the recent higher high if you want, or we can even target 20 pips. Now in this example right here, if you see these type of opportunities where the stop loss is more than 20 pips, so that way you're not gonna have a bad risk to reward ratio. Recent higher high is not really far away, so just put your target at the recent higher high and wait until market comes to that level. And here you go. This trade also performed very well. Right after we took the trade, it simply just went up towards our targeted area. So that's a simple 20 pips a day easy forex strategy that you are ever going to need. If you put enough effort in learning this trading strategy and you master it, I can guarantee that that's the only trading strategy you will ever need to make a good living from trading. I hope that you got a lot of value out of this video. If you did, let me know in the comment section what do you think about this 20 pips a day trading strategy. And thank you so much for watching until the end. If you haven't subscribed to the channel, please do, and do not forget to turn on the notification bell as well. This is it from this video guys. Thank you so much for watching again. I will see you in the next video. Bye for now.